Welcome to this explainer. We're unpacking a really fascinating corporate drama today. Imagine you're a total titan of the nutritional snacking world. For the better part of the 2010s, this was an absolute gold rush. Brands were coasting on years of booming health-conscious consumer trends, replacing sugary treats with protein-packed alternatives. But what happens when that seemingly unstoppable momentum suddenly hits a brick wall? Well, that's exactly where the Simply Good Foods company, the powerhouse behind massive brands like Quest and Atkins, finds itself right now. We're looking at their Q3 2026 earnings report, and it is a massive reality check. But more importantly, it's a masterclass in how leadership reacts when the numbers turn red, and the market demands answers.
Okay, let's dive into this. Here's the roadmap for today. We're looking at Q3 by the numbers, the brand breakdown, the turnaround plan, and finally, the financial road ahead.
Starting right off with Section 1, Q3 by the numbers. We need to establish the stark financial realities of exactly where the company stands this quarter.
Simply Good Foods just posted a staggering net loss of $52 million for the quarter. To really put that into perspective, in the exact same quarter last year, they had a net income of $41.1 million. So that's a massive, incredibly painful swing into the red. Now, a huge chunk of this was driven by an $82 million impairment charge. What does that actually mean? Basically, they had to formally admit that some of their assets are worth a lot less on paper than they previously thought. It's an accounting adjustment, sure, but it hurts. But even if we totally ignore that paper loss, the underlying cash fundamentals of the business are showing some real tangible stress that management just can't ignore anymore.
Looking at the broader financial realities, we're seeing softening across the board. Net sales dropped from $381 million down to $357 million. That's a 6.3% decline. Then you have adjusted EBITDA, which is absolutely crucial for understanding operational profitability before things like taxes, and that plummeted 22.5%, down to $57.2 million. And perhaps the most concerning part for a consumer goods company, retail takeaway actually declined by 6.7%. That's the actual volume of products being scanned and bought by everyday shoppers at the register. When top-line sales and bottom-line profitability take a hit at the same exact time, well, that's a glaring red flag that the core engine is sputtering.
Behind all this data is, of course, human leadership. And CEO Joe Scalzo, he didn't mince words. He bluntly stated that results are still well below our expectations, reinforcing the need for continuous improvement as they take initial steps in their turnaround. In the corporate world, this kind of frank admission is basically a warning shot to investors that a painful restructuring is coming. It shows clear leadership accountability. They aren't hiding behind complex accounting or blaming the weather. They're actively setting the stage for an urgent correction.
Which brings us to Section 2, the brand breakdown. To truly understand these macro numbers, we have to look at this tale of three brands operating under their umbrella.
Before we unpack those specific brands, let's quickly define a crucial metric you're going to hear a lot today: household penetration. It's Wall Street jargon, but it just means the percentage of total households that buy a specific product or brand at least once during a given period. Think of it like this. If 10 out of 100 homes scan a Quest bar at checkout over a single month, boom, that's a 10% household penetration. If this number is growing, the brand is reaching new consumers, finding its way into new pantries, and is fundamentally healthy. If it's shrinking, the brand is losing its footprint.
Now, what's really interesting here is that despite the company's overall struggles, Quest Nutrition is the undisputed shining star of the portfolio. Quest actually increased its household penetration by 120 basis points year over year, hitting 20.5% of households. It remains the absolute key growth engine for the entire company. It proves that demand for high-protein, low-sugar snacks is still incredibly robust. You just have to hit the mark with the product.
But even within Quest, we're seeing this fascinating shift in consumer behavior. It's a tale of two snacks, really. On one side, Quest chips saw a massive 17% growth in consumption. Consumers are aggressively seeking out better-for-you salty snacks. Turns out, even when we want to be healthy, we literally just want a crunchy chip. Meanwhile, the traditional Quest protein bars saw a 5% decline. The protein bar segment has become hyper-competitive, and management admits they've had less effective innovation there lately. People are kind of getting tired of those same old dense, chewy textures. They want crunch, they want savory, and they definitely want variety.
Then we have the Atkins brand. And frankly, they had a brutal quarter. Net sales down 24.6%. Retail takeaway dropped 23.9%. And that crucial household penetration metric we just talked about, it plummeted by 220 basis points down to just 8.5%. So what went wrong?
Well, the company admits that lower marketing spend led directly to distribution losses on store shelves. Plus, their messaging got really inconsistent, totally straying from their core weight management proposition. Basically, they confused their buyers, and crucially, they lost shelf space. In the brutal real estate market of a grocery store aisle, once you lose your spot, it is incredibly expensive and difficult to win it back. Retailers are just going to give that space to a competitor who's moving product faster.
But you might be wondering, why does Atkins still matter to the bottom line? Because management firmly believes Atkins has a highly relevant role to play, even in our modern era of GLP-1 weight loss drugs. Why? Because people on GLP-1 medications often lose muscle mass along with fat, right? So they require high-protein, low-carb supplements to stay healthy and maintain muscle tone. Atkins is perfectly positioned for this, provided they can actually communicate that to consumers. They know they have a substantial group of loyal, heavy buyers who use Atkins to navigate these very specific weight management journeys. The goal now is to use a strict, fact-based approach to reinvest in this core demographic and basically stop the bleeding.
Finally, there's OYN, the company's newest acquisition. And here we get a bit of a reality check. While net sales did bump up 3.6%, the actual Q3 retail takeaway declined 1.3%, and household penetration was completely flat at 4.3%. Management blames this on recent integration and execution issues. Essentially, the friction of bringing a brand new company into the fold has temporarily stalled its momentum. When you're merging supply chains, sales teams, and back-office systems, sometimes the actual consumer-facing growth just has to take a brief pause.
Let's move to how this builds, though, because despite those integration hiccups, the potential upside for OWYN is immense. Their consumer segmentation research shows that about 18% of U.S. households are actively seeking exactly what OWYN offers: functional, plant-based protein with clean labels, which is really just industry speak for ingredients you can actually pronounce. This is a huge, largely untapped demographic for the parent company. Once the current distribution reset is done and the back-office dust finally settles, the runway for this brand to capture those clean-eating households is just massive.
So, how do they actually fix these deficits? That brings us right to Section 3, the turnaround plan, acting with urgency.
So the crucial point here is understanding CEO Joe Scalzo's three-step playbook to act with absolute urgency. Step 1, strengthen the business model economics. This means taking strategic pricing actions to address inflation and aggressively slashing bloated costs across the board. Step 2, enforce strategic discipline. No more throwing things at the wall to see what sticks. No more launching dozens of obscure flavor variations hoping one randomly goes viral. They're focusing on fewer, proven, bigger initiatives to drive organizational clarity. And Step 3, rebuild brand investment. They're going to pour resources back into superior consumer insights and marketing execution, strictly allocating dollars where they see the absolute strongest, most immediate return on investment.
And they're doing all of this while maintaining shareholder value. Thanks to their asset-light business model and strong cash flow, they actually spent $25 million to repurchase 2.1 million of their own shares during Q3. Over the trailing 12 months, they've repurchased about $241 million worth of shares. Now, you might be wondering, why spend $25 million buying back stock during a messy quarter where you literally just posted a huge loss? Well, it's a psychological play. It signals to Wall Street that management believes the stock is currently undervalued and that the underlying cash engine is still highly functional despite the temporary turbulence. Now let's wrap things up with Section 4, the financial road ahead, specifically their FY26 updated outlook. Simply Good Foods has updated their fiscal year 2026 outlook, and they are definitely managing expectations downward. They're forecasting a net sales decline of roughly 6 to 7% year over year. Adjusted EBITDA is expected to range between $220 and $225 million, which represents a pretty sobering 19 to 21% decline. The message here is incredibly clear. They're maintaining their long-term growth algorithm, but this turnaround, it is not going to happen overnight. It's going to take time, a lot of patience, and flawless execution over the next several quarters. And this brilliantly illustrates how leadership is getting incredibly serious about strategic belt-tightening to survive the dip. With gross margins expected to drop roughly 375 basis points due to input cost inflation and restructuring, they are slashing capital expenditures, which is the cash used to buy physical assets and upgrade facilities. Originally planned for $30 to $40 million, CapEx is now strictly capped at $25 to $30 million. And where exactly is that money going? Hyper-focused investments, primarily on expanding manufacturing capacity for their undisputed winners, like those Quest tortilla chips we talked about earlier. They're quite literally starving the losers to feed the winners.
Which really leaves us with this final, overarching question. Can Simply Good Foods' three-step turnaround strategy outpace rapidly shifting consumer habits in a GLP-1 world?
They've got the playbook, they had the core legacy brands, and they absolutely have the cash flow. But consumer tastes, they are evolving faster than ever right now. Whether this legacy snacking giant can pivot fast enough to reclaim its growth trajectory is something we're going to be watching very, very closely. Thank you for joining me for this explainer, and keep learning.